What's going on, everybody? It's Spencer Gray from Gray Capital. And again, we are talking about multifamily investing. But if this interests you, make sure that you like this video, subscribe to our channel, hit the bell icon, and just stay up to date for multifamily information, education, topics on investing in general. All right, so today we're going to be talking about multifamily cap rates, interest rates, how they relate to multifamily cap rates, and then finally, how the two intersect and how you can use cap rates and interest rates and the spread between the two to make better informed investing decisions. All right, let's get into it. First, let's talk about cap rates. Now, we're not going to get into a very deep conversation on cap rates. We've already done a video, we've done blog posts getting really detailed about cap rates. But essentially, a cap rate, now this goes for multifamily investing, any type of commercial real estate investment. It's your unlevered yield or your unlevered return. So you're not putting debt or you're not financing the project. This is if you bought a property for cash. So let's say you bought a property for $1 million and the net operating income for that property is $100,000. Your $100,000 divided by $1 million, again, that's your purchase price, that's going to equal 0.1 or 10%. So again, net operating income divided by purchase price equals your cap rate. Now, you also can take your net operating income, divide by the cap rate if you know it, or the prevailing cap rate in your market. So you know that apartments in your market are going for 5%. So you take your net operating income, divide by your cap rate, and that's going to give you your value. This metric is incredibly important because commercial real estate is traded and sold based off of the cash flow that it produces. Now, there are other ways to value a property, but that is the main way that properties are valued. It's called an income-based approach, and you're going to be using that cap rate. So now let's look at what interest rates are, how they affect multifamily, how they affect cap rates, and then get into how they intersect. Now, interest rates. Everyone's talking about interest rates. I'm sure that you are familiar with what an interest rate is. You get, basically 0% interest if you put your money into a bank account. Essentially, it's what the yield on the return is that you're going to receive off of, a sum of money if you place it, in a bond or have it in a savings account. Conversely, if you're taking out a loan, it's the money that you have to spend to pay your lender for borrowing that money. So the most important interest rate, and this is somewhat debatable, but not really, the most important interest rate in global capitalism is the US 10-year Treasury rate. That is the 10-year Treasury bond that the US government, the US Treasury, sells to anyone who wants to buy a bond, whether that's the Federal Reserve or if that's just an individual or institution. The 10-year Treasury is the go-to rate that many institutions purchase, but it's also important because that's what so many loan interest rates are based off of. Usually when you're going to get a loan to buy an apartment or to buy any type of commercial endeavor, that interest rate that your lender is going to charge you is typically based on the 10-year Treasury rate plus some kind of spread above that interest rate. That spread is essentially what the lender is going to make when they're going to borrow those funds, even though they may not be borrowing it on a 10-year Treasury. Typically, a lender, they borrow short and they lend long. But either way, a lender is going to charge you your interest rate based on that 10-year Treasury, and it's the benchmark that most investors track to see where the cost of capital is, because the interest rate that you're going to be paying on the debt to finance a multifamily investment, it's the largest piece of the capital stack. A capital stack is essentially all of the money it takes to get a multifamily project done. And again, it could be any type of investment, any type of commercial real estate investment. We're talking about multifamily. So a typical capital stack includes senior debt, common equity. There could also be mezzanine debt, preferred equity. But typically, and to keep it simple, you have your senior loan, which usually makes up anywhere between 50 and 80% of the purchase price. And then you have your equity, your actual dollars that the investor is going to bring to the table. This is also known as your down payment plus closing costs, fees, and other things. And typically equity makes up anywhere between, again, 50% and 15% of the overall purchase price. And since that the debt is taking up so much of the capital stack, again, 50 all the way up to maybe 85% of the purchase price, the interest that you're going to be paying on that debt is critically important. Because when you look at how that cash flow flows through the capital stack, you first have to pay your lender. And so whether you're paying that lender 2%, 3%, 4%, or up to 8%, that is a significant hurdle that you have to get over before you can start paying yourself, your investors, and all of the partners in the project itself. So that's why understanding that cost of capital and the cost for that debt is critically important. Okay, so now let's take a look at how interest rates intersect with cap rates. Okay, so cap rates and interest rates, obviously they're related because the interest that you're paying on your loan is critically important to that capital stack. What are you paying in interest every single year? It's the biggest chunk that's going to come out of your net operating income. It's going to affect your cash flow to yourself, to your investors, to your group, to your project. And so where that interest rate is critically important, but also, what is that cap rate? Because again, the cap rate is your unlevered return. So you're taking a combination of what is your unlevered return and then what is your cost to borrow? What is your cost of capital for that loan? And so that's why we look at, and a lot of people look at, the spread between interest rates, specifically the 10-year treasury, and cap rates. And so we've drawn essentially a chart. This is basically the last 10 years on where the 10-year treasury is and where cap rates are. The blue line is the 10-year treasury. The black line is the US national average for cap rates. And these little asterisks are essentially where that spread is. The difference between where cap rates are and interest rates. The wider that spread, the higher the cap rate and the lower the interest rate, the higher the return that you can achieve on that property. So even if prices go up, if interest rates go down even further, you actually can get a better return compared to if prices decline and interest rates go up inversely. And so, earlier last year in the middle of COVID and the pandemic, a lot of people were concerned because, pricing already seemed very expensive. But when interest rates dropped dramatically, as you can see that happened, mid-2020, the 10-year treasury bottomed out in the 0.5% range, where we were in the mid-2% range just a year or so prior. And so that spread, you can see, we went from being in that high 200, 300 basis point spread range between cap rates and interest rates. We shot up almost to 500. And so actually during COVID, we were at an all-time high cap rate and interest rate spread, which provided a very short window to get some of the best returns if you could lock that rate in that we've seen in the last 2 decades of multifamily investing. And so we can go back all the way to 2001, running through the great financial crisis. You can see cap rates have essentially been declining for the past 2 decades. In 2008, 2009, we saw a spike in cap rates. That would make sense as asset prices declined, as there was a major bubble. And you could see that in the cap rate spread. For years prior, before the great financial crisis, our cap rate spread was in this 200 to kind of 350 point spread range. As the bubble really started getting frothy, that cap rate spread range all of a sudden dipped down into 200 into almost the 150 spread range. That shows that there wasn't as much return on your investment during that range. Prices continued to go up while the spread narrowed and narrowed. More buyers continued to flood in the market and drive prices up and returns down. After the financial crisis, we see that interest rates drop, cap rates, even while they elevated, we saw the spread widen and returns increased, which led to cap rates continuing their multi-decade long trend of downward movement. And we basically, in the past decade, we've enjoyed some really nice returns in multifamily judged by that spread between interest rates and cap rates. We're kind of in this, 300 to 400 basis point spread between interest rates and cap rates. So now the big question is, what's going to happen next? Cap rates are at an all-time low, So this chart really hasn't been updated for today, but if we, sitting here right now, we're early April in 2021, we've already seen significant cap rate compression, which makes a lot of sense given where interest rates were. Because typically, like all things in the universe, there's a cycle, and reversion of the mean is just a natural process of any given system. So we're seeing some kind of mean reversion, but since the 10-year treasury is still low, now we're off our just 0.5% 10-year treasury. We're now closer to 1.6, 1.7% on the 10-year treasury, but we're still way below kind of that all-time average. So you can see this blue line, which is the 10-year treasury. I mean, the first, between 2001 and 2010, we were pretty much in this kind of 4 to 5% range. And again, right now we're at 1.7% range. So we're still incredibly low historically. You can see this trend line going down over time. It's a pretty clear trend. And you can see that cap rates are in a similar trend pattern. We're going down. So we're going to continue to maintain this downward trajectory, and we're going to revert back to probably this 300 to 400 point spread range. Now, if things get very frothy and prices continue to increase as cap rates decline, we'll see the spread dip down into this 100 to 200 point spread range. That means returns are going to be lower, and if cap rates continue to decline, that's going to be a good indication that there's significant froth in the market. We may be in a bubble type situation. Although what I will say, the big difference between 2007, 2008, 2009, and where we are today is supply and demand. We were oversupplying during this period in 07 and 08, where we really haven't been able to catch up since then. And so even though we have been building more, we're still absorbing the new deliveries that are coming online. So we're not seeing the supply-demand pressures. In fact, we still have a supply-demand imbalance. So given that we still could see somewhat of downward cap rates, more likely with that supply and demand imbalance, we're likely to see increase of revenues, rental increases as interest rates potentially increase with inflation, driving top line growth, increasing the overall purchase price of the asset, while not necessarily seeing additional cap rate compression. And again, we'll just be reverting back to seeing this normalized cap rate, interest rate spread, somewhere between this 200 and 300. That's a pretty healthy range. If we're in this 300 to 400, that's great. That means it's great for yields. But we can't predict the future. We're not sure. So this is incredibly important when you're looking at making a multifamily investment. It's not just enough to look at what the cap rate is, what the purchase price is. It's what is it relative to. It's all things are relative, especially in finance and economics. It's what is the relative yield. And this 10-year treasury is the ultimate relative. There's also the 10-year treasury. We didn't mention this, but it's known as the risk-free rate or the discount rate in economics. Because essentially, it's considered if you want to make an investment and take no risk to get a return, well, that's what the 10-year treasury is. And all other investments and assets, their returns and their risk premium is based on this discount rate. So essentially, any return that you're going to receive in excess of the 10-year treasury is your risk premium, and different assets are traded and are evaluated based on that discount rate and that risk premium. So multifamily, as you can see, provides an excellent risk premium compared to other assets, not even getting into all the other benefits of real estate and multifamily investing. Cap rates, interest rates, spreads. I know it's a lot of stuff, and these are all specific topics that we could go really deep into, but I wanted to give a quick overview of how they interact, what the relations are, and get you thinking about not just what the purchase price is, what the cap rate is, but what is the relation between the cost of capital and the return, the unlevered yield on these assets themselves. Hopefully you're going to be thinking about things a little bit differently, taking a more nuanced perspective and approach to evaluating real estate investing opportunities. If you all enjoyed this content, this video, again, please give us a like, subscribe to the Gray Capital YouTube channel, hit the bell button if you'd like to receive updates and alerts every time we upload a new video. And if you watch all our videos, jump on over to graycapitalllc.com. We have a lot of other exclusive content over there from our blog, podcasts, just all kinds of exclusive content. Go check it out, graycapitalllc.com. And if you're interested in getting in touch with Gray Capital, you can join the Gray Capital Investment Club, also on graycapitalllc.com. I'm Spencer Gray, president of Gray Capital. Have a great day.